In this video, I'll explain the basics of the foreign currency exchange market, or Forex for short, and we're starting right now. Hey guys, welcome to the Keystone Financial Academy. My name is Elliot, and today I want to introduce Forex and Forex trading to those who are new to this and want to learn the basics of this very interesting topic. Now, of course, you won't become a Forex expert after just this one video, but this will be a solid introduction to what it is. Let's get into it, and as always, if you enjoyed this video and find it useful, please do subscribe to the channel, helps me out a lot, and also smash that like button. So chances are you may have heard of Forex, but you weren't sure what it was all about. The foreign currency and exchange market, or Forex for short, is a global market for the trading of currencies. It is by volume the largest market in the world, with about 6 trillion in currencies being traded daily. While the majority of this is in fact done by large institutions, the average trader can learn the techniques and join in. The key concept behind Forex is easy to understand if you've ever traveled overseas and exchanged the currency of your home country into the currency of the country you're about to visit. You were shown an exchange rate and then paired up the currencies trading one for the other. That in essence is the Forex market, and you were a willing participant as you handed over your dollars for some euros, heading over to Italy on your pre-COVID dream vacation. Now, it's obvious why you would engage in the exchange of cash as a traveler, but why would investors and large institutions trade currencies on the Forex? Well, for traders, it's a form of speculation and a way to make a profit off of the differences in the prices of the currencies. Traders buy a currency that they think will increase in value against the currency they sell, and they can then sell it back into the market for a profit. At its core, Forex trading is just a way for investors to make money off of an appreciating asset, in this case currencies, and is in principle no different than trading stocks in hopes of a price appreciation. Forex is also a major tool of multinational corporations that manufacture products in one country but sell it in another. They use Forex trading to protect their profits against the fluctuations of one currency versus another, so Forex could be thought of as a necessary side effect of global trade. Now, Forex is a pretty unique market because there's no centralized exchange to handle the worldwide trading. All currency trading is instead handled electronically and completely over the counter. The Forex market is also uniquely liquid. The item being traded here is currency, or money, and more money exists in the world than stocks, bonds, or really anything else. Money is accepted by everyone, everywhere, so a Forex trader can instantly open and close positions, which just means that they can easily find buyers and sellers. Finally, Forex is a highly leveraged form of trading, and really this is the only way to make a profit in a very tight and very liquid marketplace. But being leveraged is potentially a dangerous thing to be, and I will go over this a little bit later. So as you can probably see, the concept of Forex is quite basic in principle. You're just trading one set of currencies for another. But in practice, things can get very intricate and very complex rather quickly. I will need to introduce a number of new concepts and terms, so let's take the time to explore it all, starting with the Forex market operating schedule. The Forex marketplace is global and nearly constant, operating 24 hours per day and 5 days per week, with trading based around 4 major centers, which are referred to as sessions. There's the Sydney, Australia sessions, the Tokyo, Japan session, the London, UK session, and the New York, United States session. Due to the physical location of these cities and the time that the traders are up and at work, there are overlapping time bands or market sessions where you can expect the busiest trading activity and movement in the Forex marketplace. What does that actually look like using Greenwich Mean Time as a reference clock? Well, here is a graphical representation. On 3 separate occasions in any given day, these 4 sessions overlap enough to create a peak trading session where there's a lot of action. This is known as the Forex 3-session system. The 3 of them are referred to as the Asian or Tokyo, European or London, and the North American or New York peak session. Okay, so that's the general time schedule that the Forex marketplace operates on. Let's now discuss actual trading specifics. In Forex, you're trading a currency pair, which means you're selling one currency and simultaneously buying another. Each currency currency in the pair is listed as a 3-letter code, where the first 2 letters usually stand for the region or country, and the third one usually for the currency itself. For example, USD stands for the US dollar and JPY for the Japanese yen. In the USD-JPY pair, you're buying the US dollar by selling the Japanese yen. In theory, you could trade any 2 currencies in the world, but in practice, only a handful of currencies get traded on a regular basis. And the vast majority of the world's currencies are either not traded or traded so lightly so as to not even register with any useful metric. The top 10 most traded currencies by value are shown right here, and as you can see with the percentage of market share, it's really the top 5 comprised of the US, European, Japanese, British, and Australian currency that dominate the market, and most pairings are between these top 5 or the top 10. 4 types or categories of currency pairings are recognized in forex trading: major pairings, minor pairings, exotic or emerging market pairings, and regional pairings. Major pairings are currency from major global powerhouse nations and one region that together make up about 80% of the global forex trade. Major pairings are associated with stable, well-managed economies, are less susceptible to manipulation, and have smaller spreads than other pairings. These pairings typically have the lowest volatility and the highest liquidity. And the 7 major pairings, along with their informal nicknames that you will sometimes hear used among traders, are shown right here. Minor pairings are less frequently traded and often feature major currencies other than the US dollar. They are also referred to as cross-currency pairings. They are typically more volatile and less liquid than major pairings. Many minor pairings are in use, and some lists include up to 14, but these 6 see the most trading. There are also exotic or emerging markets pairings and regional pairings, but I won't get into them in this video. So let's try out a common pairing as an example, in this case the euro and the US dollar. This would be written as EUR/USD. The first currency listed, in this case the euro, is the base currency, while the second one, in this case the US dollar, is called the quote currency or the counter currency. The base currency is the one you're buying when you're trading the forex pair, and the quote currency is the one you're selling. Like any market buy-sell action, a forex trade has a buy price and a sell price. The difference between these two prices is called a spread, which is essentially the same terminology as with stock trading. In forex trading, the spreads between the currencies are usually very tiny, reaching out to 4 or sometimes more decimal places. Special terminology called the pip, or percentage in point, exists to measure the movement between the pairings. 1 pip happens to be the change in the 4th decimal point as seen here. Any numbers after the 4th decimal point are fractions of a pip and referred to as the micro pip or pipette. Currency in forex is traded in various lot sizes. The standard lot is 100,000 units of your base currency, so an even $100,000 if the US dollar is the first currency in the pair. Other common lots include the mini lot, which is 10,000 units, and the micro lot, which is 1,000 units. If this seems like a lot of money to enter a forex transaction, it is, but leverage is used extensively in the market. Leverage is, of course, when you use a little bit of money to control a much larger amount. A key part of leverage trading is what's called margin. Margin is the initial deposit you put up to open and maintain a leverage position, and this requirement will change depending on your broker and how large your trade size is. Margin is usually expressed as a percentage of the full position. A trade on a mini lot of euro versus the US dollar, for example, might only require a deposit of 2% of the total value of the position for it to be opened, meaning that while you're still risking $10,000, you'd only need to deposit $200 to get the full exposure. Why is this leveraging so important? Well, if you recall from just a few minutes ago, the spreads in forex trading are very small, so you need to trade in very large lots to see a profit, and this is where leveraging helps the small investor. Finally, we need to discuss forex contracts. How exactly you trade currencies on the forex depends on what sort of contract you're using. While the FX spot contracts are of most relevance here, there are a few others such as futures, forwards, and options. Spot, however, is the typical or the more conventional of the forex contracts, and what the vast majority majority of individual traders deal with. Here, the delivery and the settlement are immediate. These contracts state how much you would pay in one currency to buy another at this moment in time, based largely on supply and demand. In finance, spot means the transaction is carried out as soon as practical or as close to on the spot as possible. The trade is typically executed directly via an electronic order matching system or a proprietary platform, which I'll discuss in just a moment. The settlement date is about 1 or 2 days after the transaction. The FX spot deals with actual currency, but in practice, no actual currency is physically delivered, and only the profit and loss amount is settled, with all transfers, of course, electronic, not physical. So everything I just covered thus far makes up the fundamentals of Forex and the basic details of this type of trading. Technically, you would now be able to start, but we still haven't talked about trading brokers and trading platforms and how to actually place an order. We also haven't talked about strategy, so you're not just blindly placing orders and most likely losing money. Let's tackle brokers and platforms first. To start Forex trading, you of course will need to open a brokerage account, gain margin privileges, and fund your account. Forex trading can be done on all the major broker platforms such as TD Ameritrade, E-Trade, Fidelity, or Charles Schwab, or many others. There are also specialized brokers such as Oanda, IG, XTB, and Forex.com. When seeking a broker, look for multi-tier or multinational jurisdictions and of course good online reviews. Even with brokers that have good reputations, there's a lot of variety in account opening minimums, customer service, and transaction fees charged. A good Forex broker should offer a lot of currency pairings and can provide an excellent trading platform with advanced charting. Once you pick a broker to work with, you open an account by providing some personal information, including your experience level, and then you fund the margin account via a debit or wire transfer. Finally, you select the currency pair, analyze the market, read the quote, pick your position, and buy or sell. Now you may be wondering what platform all these brokers use to actually do Forex trading. The best known platform in the Forex industry is MetaTrader. Developed by MetaQuote Software and first appearing in 2005, it is independently licensed to Forex brokers who in turn offer it to their clients. The most recent and updated version is MetaTrader 5 or MT5, but MT4 is still widely used. Aside from MetaTrader, a lot of other platforms certainly do exist, with a significant number of them proprietary to the individual brokers. So these are the mechanics of getting started, and they're fairly straightforward. However, the devil is in the strategy. If you randomly buy and sell currency pairs, you will more than likely earn yourself a loss, not a gain. So knowing what you're doing is of course the key here. For this, we have to mention strategy and just do a quick overview because this topic itself can take up many videos. To state it bluntly, success in Forex trading is not based on dumb luck, but on discipline and knowledge. Successful Forex traders use leverage effectively, know when to cut their losses, follow world events carefully, and know when to trade and when not to. As with stocks, there are two approaches: fundamental analysis and technical analysis. Let's start with the first one. At first glance, Forex doesn't seem to lend itself well to fundamental analysis the way corporations do. No balance sheets or investor conference calls exist that you can look over, and how would you analyze currencies anyway? Well, it turns out that a number of macroeconomic factors can in fact be examined, with the primary ones being the leading and lagging economic indicators. These are major nationwide statistics such as unemployment numbers and are roughly equivalent to a company's earning report and can be an indicator to a country's overall economic health. Another factor to examine is the gross domestic product or GDP. GDP is the total market value of all the goods and services produced by a country in a given year. It is the broadest measure of a country's output, economy, and internal growth, and is somewhat analogous to a company's gross profits. Yet another factor is consumer spending and retail sales. This statistic is exactly what it sounds like, and it monitors consumer participation in retail sales. Consumer sentiment and sales can indicate the direction of an economy, and it's roughly comparable to a company's sales activity. Some other indicators may include the Consumer Price Index or CPI, industrial production, and many more. Additionally, Forex fundamental analysis takes a look at the company's political situation. Is it stable? Are there any changes at the top level of government? Will political or economic plans significantly affect the currency? currency, such as pegging the currency or leaving a major partnership such as with Brexit. Some of these will weigh heavily on currency movements, and a solid prediction can be guessed with a fundamental survey of the country's political and economic profile. So that was a quick look at fundamental analysis. Technical analysis also plays a major role in day-to-day forex trading. And in a nutshell, technical analysts believe that all available information is already priced into the currency pairings. So their focus is mostly on predicting price motion, interpreting trading signals, and determining the correct entry and exit points in order to buy and sell. Forex traders, of course, use trading platforms to assist with analysis and place trades, but the interpretation of the data is still up to each individual trader. Price movements and trading signals in technical analysis involve a lot of unique to that field terminology and tools such as Bollinger Bands, candlesticks, and support and resistance lines. And the details of these could truly fill up quite a few other videos. It is a good idea to master technical analysis before applying real money to trades, so virtually all forex brokerages offer a demo account to safely learn and practice in without using real money. Okay, that was a whirlwind overview of forex, and if you're a complete beginner to this topic, hopefully you now have some basic understanding of what it is. If you enjoyed this video and found it useful, please do consider subscribing to the channel and turning on notifications so you don't miss any future videos just like this one. Thanks for watching, and I'll see you all soon.